You know, our world is stitched together by a massive, invisible web of commerce. A product's journey from idea to your hands is more global now than ever before. But here's the big question. Is this system a perfect deal, a win-win for everyone? Or is it a perfect storm brewing with hidden dangers? Let's dig in.
Seriously, just think about the shirt you're wearing right now. Where did it come from? The cotton might have been grown in India, the dye made in Germany, the whole thing stitched together in Vietnam, all from a design cooked up in California. Your closet, it's like a tiny museum of this huge, interconnected global economy. And the choices companies make in that economy, well, they tell us everything.
Just look at these two completely different paths. On one side, you've got a giant like Nike. They basically built their empire on outsourcing, right? Finding partners all over Asia to make their stuff. But then you have a company like American Apparel who argued the exact opposite, that it was actually more efficient to keep everything in-house. Two companies, two strategies, one global market. This really sets the stage for the big questions. What are the promises and what are the perils of trading across borders? Okay, let's start with the good stuff. For centuries, the argument for free trade has been incredibly powerful, and it all boils down to a pretty simple idea. I mean, at its core, that's all it is, right? Buying and selling stuff across borders. But that simple act has completely and totally reshaped the world we live in. And if you ask its supporters, the benefits are just massive. So here's the sales pitch for global trade. The idea is that it makes every country that participates wealthier. It increases the total amount of stuff the world can produce. It can even build stronger cultural and political ties. You can get materials you just don't have at home. Competition forces your own companies to get better. And all of a sudden, your market isn't just your hometown, it's the entire planet.
And here's a really crucial point that I think gets missed a lot. We tend to think international trade is all about one thing, finding the cheapest place to make something. Paying workers dollars a day instead of dollars an hour. And yeah, that is a huge part of it, no doubt. But it's not the whole story.
I mean, think about these. Nobody buys a Swiss watch because they're looking for a bargain, right? You buy it for the quality, the heritage, the craftsmanship. Same thing goes for German cutlery or Scottish wool. International trade also lets countries that are the absolute best at making one specific thing share that unique talent with the rest of us, satisfying tastes that have nothing to do with the lowest price. But this rosy picture definitely has a shadow side. All right, so now let's flip the coin and look at the other side. Because for every amazing benefit, critics will point to a potential disaster. The very engine that's supposed to create wealth can sometimes, believe it or not, make a nation poorer. This concept is just wild, and frankly, it's a little terrifying. It's called immiserizing growth. The idea is that a country can go all in on exporting one thing, say a single crop or a mineral, and they push so hard that they actually drive down the global price for it. The result? They have to export more and more and more just to make the same amount of money. They literally get poorer by trying to get richer. And the risks don't stop there. A country might strip mine its natural resources until they're just gone. Its new, fragile infant industries can get totally crushed by powerful foreign competitors before they even learn to walk. And when you specialize in just one or two things, you can lose jobs in other sectors and become dangerously dependent on other countries for basic needs. These economic worries are big enough, but the simple act of shipping all this stuff around the globe raises an even bigger question. So beyond all the purely economic risks, there's this huge existential question hanging over global trade. What is all this producing and shipping and consuming doing to our planet? This quote from the really influential Stern Review in the UK puts the stakes in brutally clear terms. The cost of doing nothing about climate change could be catastrophic. We're talking about wiping out a fifth of the world's entire economic output. That forces a really tough conversation. How do we possibly balance our desire for economic growth with the urgent need to keep the planet livable? So what's the plan? Well, there are two dominant ideas on the table. One is carbon trading. Basically, the government sets a limit, a cap, on total emissions. If you're a clean company and come in under your pollution allowance, you can sell your extra permits to a dirtier company. The other path is just a straight-up carbon tax. The logic there is simple. Make pollution expensive, and the market itself will find the most efficient way to stop doing it. It is a massive debate, and there is no easy answer. So with all these competing interests, jobs, growth, the environment, who manages this incredibly complex system? Who are the referees on this global economic playing field? Well, one of the most powerful players is the IMF. When a country finds itself in serious financial trouble, it often turns to the International Monetary Fund for a bailout. But that help, it almost always comes with strings attached. And this is the crucial part. The IMF doesn't just hand over a check. It demands huge policy changes, what they call conditionalities. We're talking about forcing countries to sell off state-owned companies, like their national airline or power grid, opening up their markets to foreign money, slashing government subsidies on essentials like food and fuel, and, of course, a full-on embrace of free trade. The idea is to force a major structural adjustment, but it's an incredibly controversial approach.
And this is why it's so fiercely debated. Critics argue that forcing countries to open their markets too fast actually helped cause the devastating East Asian financial crisis back in the late 90s. And when governments have cut those subsidies on food and fuel, it has led to riots and massive civil unrest. This gets to a fundamental question. Is the IMF a neutral financial firefighter rushing in to put out fires, or is it an engine for imposing a very specific Western free market ideology on countries when they are at their absolute weakest? Now, despite all of these risks and all the controversy, the pull of global integration is just incredibly strong. And to understand why, you just have to look at this number. Just let that sink in for a second. 378%. What on earth does that represent? It represents the absolutely staggering growth of India's economy in just 12 years. As India increasingly opened itself up to the world through trade and investment, its GDP just exploded. This is the incredible promise of globalization in action, the promise of creating wealth and opportunity on a scale that's almost hard to wrap your head around. It's the reason why, despite all the very real fears, countries keep chasing the dream of international trade. So that's where we're left. On one side, you have this potential for incredible wealth and growth, and on the other, you have these massive risks of inequality, environmental destruction, and economic instability. It forces us all to ask a really fundamental question. As we keep building this deeply interconnected world, what are we willing to pay? What is the true price of progress?